Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by California State University's Small Business Development Center. This is webinar number 263. I'm your host today, Kelly Bearden, the director of the center here in Bakersfield. Welcome. Glad to have you here. Got a great program coming up, a little change of plans from what we might have been talking about in the past, but we can't find a more timely subject to talk about, conversations you need to have with your financial experts. And so we're going to jump into that in just a little bit. And let's start rolling into next week. Well, not quite yet, but next week our special guest will be Sandra Pedrotti, and she is with the USDA's Rural Development, and we'll be talking about a grant program through USDA that many do not know about, and that is the Value Added Producers Grant, the VAPG as it's known, an acronym, and it is open right now, and they have about $20 to $25 million across the country for agricultural businesses that want to take their product or their recipe from commodity stage to adding value. So what's up today? February the 15th, 2023. We're going to be talking about prepping for the tax man. And when we talk about prepping for the tax man, great Beatles song, by the way, we're not only prepping for the tax man, but we are also hopefully planting the seed today on questions to ask that tax man on what is going on in your business, what can you do, any questions that you might have. This topic kind of came up, and it came from a number of conversations with small businesses that might only meet with their financial expert once a year, or possibly it's twice or three times a year. And really understanding from preparation of the tax return and some other financial statements what's going on in your business is vitally important. So we're going to spend a good amount of time on that today, prepping for your tax man, not only for your 2022 return. Last year, you can do very little to change that, but what can you change in 2023? And maybe what are some of the patterns that are happening in your business that your financial information is telling you? Also, we're going to talk today a little bit about Capital Quarter. We'll do our Capital Quarter segment that we do on a weekly basis. And today we want to just revisit some of the disaster filings and the disaster declarations that came out after the floods in late December. So the rain and the floods and some of the issues that are going on, we might spend a little bit of time talking to our local expert on the ERC, the Employee Retention Credit. Last time Michael Stevenson was with us was 16 months ago, and we were talking about the ERC, and we're still talking about the ERC. So, and we've been talking about it about every week, and I really love the advice that we've given you for this entire ride. Contact your financial professional. Also, we might jump into and have a minute or two to talk about the Restaurant Revitalization Fund and that tax credit that may be a remedy for those that did not get that particular grant. Our economic corner today is going to settle on a report that came out this week, the Consumer Spending Report, and some information on it, and try to let you know why it's important that you know what's going on with the Consumer Spending Report and the value that consumers have in the overall economy today. On our notable news, maybe we hit a little bit on financial statements, and I don't know about understanding financial statements, but recognizing maybe some things and patterns that are happening in your financial statements. We'll talk briefly, and maybe we'll get into a larger discussion later on financial statements, pretty much your profit and loss statement, your balance sheet, and perhaps something else. So for your business news and info for 2023, it's going to be here on Webinar Wednesday. We'll take your questions at the end, as always, and usually we have a poll, and looks like we have one today. So our poll today, not really getting into the whimsical today, trying to keep it a little bit serious and talk about a couple of the factors we're going to be talking about in more detail. So let's look at a couple of polls. And the first one is just a question on consumer spending. Okay. I think I'm back. Apparently today's poll question was, can I throw the host off the webinar? And yes, the answer was yes to that particular poll question. So I think we're back, at least I think I'm back. Um, you know, and continuing on with my internet disruption there that can happen. But I'm going to try this poll one more time because I can't believe a poll would actually throw me off the internet. And so the poll is on consumer spending. I'm assuming I'm back. And consumer spending is a significant chunk of our economy and GMP. What percentage is it? Is it 37%, 69%, or 80%? So consumer spending is a significant chunk of our economy. What percentage? 37, 69, or 80? Okay, we have about 45% of you participating. Been thrown off the internet before on these webinars, but that one was a little bit different. Didn't like the poll question apparently, and that is consumer spending is a significant chunk of our economy and our GDP. What percentage is it? Give you one last chance to get in. We got 56% of you in, 37, 69, or 80%. Okay, didn't quite hit my 60%. There it is, 60% of you have responded. I'm going to end the poll right now and share the results. And the results you think are correct. That is 69%. Yes, a shade under 70% consumer spending affects the economy. 33% of you thought it was 37%, and 20% of you 80%. Isn't it ironic with we talk so much about the 80-20 rules, I like to call it, that 20% of you would think it was 80%. That is just too good to believe. Okay, well, thank you for participating in our first poll question. And again, it kind of goes into with consumer spending, it shows you why we talk about a lot of the things that go on in the economy as far as inflation, as far as jobs. Obviously, consumers are going to spend more when they have jobs. It all kind of ties together, but the consumer spending, a huge part of it, not as much as government spending or business spending, but consumer spending, a huge share. Okay, so that's poll question number 1. Do I dare show poll question number 2? And maybe the answer is I do not, but let's try to understand why the polls are being so problematic today. And we will not have poll question number 2, according to Zoom, and we were going to be moving along. That was a great poll question too. Well, we'll bring it back and try one more time. Poll question number 2. Yes, there we go. Poll question number 2 is, what is your biggest tax worry? And is it paying or maybe owing still too much tax, not getting all your information together, not knowing your complete financial situation? I started realizing there could be about 20 answers to this question. So if you have any others than those 3 right there, go ahead and put it in chat and we'll use it as a discussion point later on. So what we're looking at is your biggest tax worry, your biggest income tax worry. We are hitting income tax season. It's the lull before the storm. And is it paying or still owing too much? Is it not getting all your financial information together, or is it not knowing your complete financial situation? So I think you like this poll more than the last one. 65% of you have participated so far to the second and last poll question of what is your biggest tax worry? Paying or owing too much, not getting all your information together, or not knowing your complete financial situation. Okay, we're going to go ahead and end the poll and share the results. And others, if you have any other thing, go ahead and put it in the chat box, and maybe we will come to that at a later time. Sharing the results with you right now, we see that 53% of you are concerned, your biggest concern is paying or owing too much tax. 26% is getting your information together, and 21% is not knowing your complete financial situation. Okay. So thank you for participating in that. And let's move along. So, our capital quarter today is going to focus a little bit on a couple of things. And one of them is the disaster recovery from the floods and the weather storms that we experienced in the latter part of December of 2022, and maybe even a little further than that. So one thing you need to know is if you had physical damage, that the due date is coming up on when you can file a claim. It is both a FEMA and a actual disaster in a number of counties. But there are the two types of damage that come from disasters. That's physical damage that was done by the rains or winds or the floods. That's due next month on March 16th. You have not a lot of time left to get in that physical damage that is due to either FEMA or the SBA. And then also there's the economic injury. The EIDL program, which so many of us accessed during COVID, is open until November 16th. Now, the important thing on this, on why it is opened a lot longer for the economic injuries, because a few things, you might not even know you have economic injury at this point. You could have potentially, maybe your biggest customer is in one of the disaster areas and they're not buying any product from you because they've been unable to reopen their business. So maybe that is a really good example on why you would have an economic injury and you have a later timeline in order to actually file. But for physical damage, it's coming up on March 16th. To date, SBA has paid out over $25 million statewide due to that disaster. And one of the things that a lot of people don't look at is that there is disaster mitigation to protect against future disasters that can be claimed as well. So you can get funding in order to protect your business. Let's say it's on a floodplain and there's a creek that overflows regularly. Maybe if you did some disaster mitigation to that and maybe beefed up a levee, did something in order to protect against future disasters, then those funds are available for that potential use as well. A lot of people don't really realize that. So the storms happened going back to December 27th. Originally, there were 3 primary counties, as they were called. There have been more added. As you can see, that there's a number of businesses and nonprofits. Generally through SBA, it is done through a disaster loan, 2.75% or slightly higher for those particular programs. FEMA has some that are more in the range of grants. A lot of different avenues that you can go up. Disaster loans up to $200,000 are available to homeowners to repair structure. But we want to just make you aware that that for property damage, it is coming up. And really, you'd like to either contact one of these 2 sources. It's going to be the SBA at the bottom number of 800-659-2955. That's their call center. But also you can go to disasterassistance.gov for FEMA, the Federal Emergency Management Agency. So those dates are coming up, and you can find out more at this particular location, this FEMA website, disaster number 4683, the designated areas, and what has maybe happened since we talked about it last. So time's coming up. So also coming up is some of the notable news I'd like you to know. And we're going to talk a little bit about this, about understanding key financial statements. And we'll get into a discussion on that. So if you were the one that was concerned about, or several of you out there, dozens maybe, that were concerned about your financial information, then we'll talk a little bit about some of the key financial statements. And that's going to be your profit and loss stock and changes that you've had from year to year. So any of the changes that you've had, it's really good to look at trends that are happening in your business from your financial information. And I think a lot of people don't do that I talk to. So just going back, and I realize that there has been a pandemic that has changed a lot of potential results in the tax years of 20 and 21. 22 was getting back to more normal, but you can even go back and look at 19 and maybe 18 if it's appropriate and you were in business at that time. But just having a trend line and looking at how maybe some of your expenses have changed and some of your expenses have actually changed from either good or bad. Maybe you've been able to reduce some of your expenses in some items, and maybe some of them have blown up really to significant amounts that need your attention. Really, the importance of the balance sheet, which is a harder concept, I think, for a lot of small business owners to grasp, is really vitally important. And yes, you know my love for cash flow. So with time, always we talk about cash flow forecasting and having your cash flow. An event that we're bringing to your attention, we're starting maybe this community calendar where we get into some of the things that are happening throughout Kern County that might be of interest to you, maybe even beyond Kern County. But the Indian Wells Valley Outlook Conference in Ridgecrest is an annual event that is a half-day conference. This year it's held at a different venue at the Desert Mountain Fairgrounds in Ridgecrest. It's a half-day event hosted by the Ridgecrest Chamber. And really what it does is it talks a lot about the economic outlook for the greater Ridgecrest area. So if you've wanted to do some business development in Eastern Kern County, throughout maybe the Ridgecrest area, maybe it's with Naval Weapons Station China Lake, the city out there, some other areas, this is a great place to go and actually increase your contacts for that particular area and to find out what's going on. So our keynote speaker at this event will be our very own Dr. Aaron Hedgay, our chair of our economics department at CSU Bakersfield. So more information is available through the Ridgecrest Chamber of Commerce. Brought to your attention last week that if you are looking to do more as far as customers, as far as SEO and Google ad projects, and would like to partner with the CSUB marketing class and some of the students in some of the marketing classes, you're going to want to contact Jimmy, Professor Jimmy, there's his email address, which is, I still think, one of the coolest email addresses out there. It's cxu3@csub.edu. And they are, during both spring and fall semesters, they're going to be working on group projects and to boost your online marketing presence. So for more information, contact them. So more news I'd like to know. We'll have a little coming soon section, and coming soon on some of the more news I'd like to know is that there's likely a City of Bakersfield program that's going to come and assist small businesses. Yes, pretty sure this is coming actually. We'll talk about it more in the incoming weeks, but if you're looking to start or have started a business in some of the more low to moderate income census tracts within the City of Bakersfield, there could be grant dollars available for you, particularly if you go through training, consulting, and business plan preparation. For those of you that maybe might have been familiar with the California Dream Fund and the nearly 60 businesses we worked with on that particular project, it's going to be somewhat similar. So stay tuned for more information on that. You can also go to our YouTube channel and find some true oldie but goodies. Not too old at all was our HR update from Celeste John Ramos back on January the 11th, I believe it was. We had also Stephanie Sievers, the CEO of Alt One Credit Union, talk about a lot of the lending resources, an economic update, and some update on other programs, IP, and franchising your business. So some oldies but goodies out there. You're going to want to contact your local SBDC for some of the tools that we have. We talked a little bit about LivePlan earlier. SBDCnet is our national information clearinghouse for market research information, and some great information that they pull up from a variety of sources that assist SBDC clients in knowing more about their market, their demographics, and their potential even competitors within a retail area. It's a great tool to take advantage of. It takes a few weeks to get the information. Only open to SBDC clients, but really reach out and look at that particular aspect as it goes. Okay. So today, our special guests, our panel, is me and Michael Stevenson. And Michael is a Bakersfield native with a decade of experience in public accounting. He began his career with the firm in 2007 and has been a shareholder since 2017. Is a certified public accountant specializing in taxation, compliance, and tax planning. A grad of Cal Poly, San Luis Obispo, a member of the California Society of Public Accountants. Mr. Stevenson currently serves as president of the Cal CPA Bakersfield chapter. I believe he's still a president. He's a runner, actively involved with CSU Bakersfield, with our accounting advisory groups, frequent guest speaker on campus. A lot of the accounting programs are really benefiting from his expertise when he comes into the classroom, heavily involved in recruiting, spends a lot of time with power sports, camping, spending time with his wife and 3 children. Michael, it's great to have you back. It's been too long, my friend. Let's have some conversation on what's going on.
Absolutely.
All this tax preparation stuff. So take it away.
My pleasure, Kelly. So, when we talked yesterday and said, hey, what do you think about doing this deal tomorrow? So I jotted down some notes as far as what I would want my clients to ask me when we're meeting annually. I think too often people focus on the tax return, getting preparation done, whether they owe or not, and they really lose sight of what the value their CPA can add. Most CPAs, myself included in this firm, we have a lot of clients in various industries, really heavily involved in the business community in Bakersfield. And so we have a lot of connections and we see a lot of what's going on locally. So I think one of the most important things that a client can do is take advantage of that time you have with your accountant to discuss the trends that are coming down, the challenges that are facing other businesses in your industry. So what I encourage people to do is start with that. What trends are you seeing in my industry or locally? Are we seeing a push to increase prices? Are we seeing a lot of people scale back advertising spending? Are we seeing a lot of people that are putting a hold on hiring or are looking to hire? If people are looking to hire, what kind of wages are they having to pay? These are the kind of things that aren't proprietary data that your CPA can share as long as you are looking for that information. No one, for example, let's go back to hiring, wages. You think this is something that's generally outside of a CPA's purview as far as the operations of your business is what you pay people. But they're going to have a pretty good handle on what the local market is. And that can tell you if what you're offering employees is in the market or if it is outside, either above or below market. And you can adjust your benefits packages and wage packages correspondingly to get the level of interest you want. You may be looking to push wages just because you can't find anybody, but when you talk to somebody and you realize that everybody else's wages are pretty much in line with yours, it really comes down to a question of, is it a wage issue or is it a issue with the people just not being available to hire? Another important one, I think, is asking your CPA, what kind of programs should I be looking at? What's out there for me? This might involve things like the employee retention credit, which we'll talk a little bit about later. If you're a farmer, there might be USDA programs that you're eligible for. So, asking your CPA what they're seeing other people go out there and look at will give you a handle on what you should be looking at as well. Could be a variety of different programs. Obviously, the KDC is a good avenue for this as well, but it's always good to get an opinion from somebody else. One of the things that hit me when we did that poll question is that the biggest worry by far for people seemed to be is owing tax or needing to pay once they get the tax return done. That's kind of striking to me, because really as business owners, you should be utilizing your CPA and their team to manage your earnings for purposes of income taxes. So you really shouldn't get to the end of the year and have no idea what your liability is going to be. That should pretty well be handled in December. And if that's not something you're currently doing, talk to your CPA about it and ask them, hey, what can we do earlier in the year to either get a handle on what this liability is going to be or to minimize it? And have conversations with them regarding some planning options you may have. And it may come down to entity structure. Maybe you're operating as an LLC and you'd be better off to operate as an S corporation to minimize tax liability. Could be you're operating as a LLC, and based on the nature of your business, it doesn't really make sense to do that. You might be better off as a sole proprietorship and just buying additional insurance to cover any potential liability. Could be any number of things. One big one that we see people overlook and can to some extent be dealt with after the end of the year would be having a 401k plan or an IRA. If you have a 401k plan, it's got to be set up before the end of the year, so the end of 2022 to be in effect for 22, but it doesn't necessarily have to be funded until 23. So talking to them if you potentially have a liability and saying, hey, what can we do at this point to minimize that liability, might be a good topic of conversation. Perhaps we can put money into a 401k for the owners. If we can't do a 401k, what about a SEP IRA or even a traditional IRA? These are things that can be done after year end, as well as the election between bonus and no bonus as far as depreciation. What we like to see is people that see the value in those services. And I think that pretty much anybody on this call that's operating a business, if you really sit down with your CPA and talk to them about what your goals are, what your expectations are, and really start to get their insight on some of this tax planning and tax minimization stuff, you're going to see a huge benefit. So we like to do that. The other thing that I would like for people to do when they meet with us on an annual basis is to share a little bit about where they want the business to go. What are your goals with the company? Do you want to expand? Do you think your industry is dying and you're going to have contraction issues? Do you want to potentially sell it and transition to a less risky investment or a investment that takes less time? Maybe you've got a farming entity that you want to liquidate in the next few years and transition to commercial real estate to generate income in the foreseeable future. Those are the conversations that you need to take the opportunity to have with your CPA or anybody else in business that you meet with on a periodic basis. Usually your CPA has seen those types of transactions, or at least they should have, and they can give you some advice on what they've seen that's worked well, what hasn't worked well, what some of the tax implications might be associated with that, and kind of walk through the transaction with you and really determine, have you seen all the angles of this, or is there something that you're missing? So encourage you to share your goals, encourage you to share where you want to go, get their opinions on it, and have those conversations about your specific situation, where you want to go, how you're going to get there, and what the implications of that action is going to be. So, I mean, in a nutshell, those are the kind of things that I'd encourage you to do. Is, to me, that annual conversation tax time, the last thing you should be talking about is probably taxes. The bigger conversations are the health of the business and what you want that business to do, what your long-term goals are and expectations are, and how do we get there. Most CPAs are here to be a partnership with you. And so utilize that resource and have those conversations. What do you think, Kelly?
Well, I think those are great ideas. And you touched on a few things that I really want to talk about more. And the first one is I really liked hearing the goal setting, because I don't think enough small businesses do that, where they have targets for revenue. They have targets for growth as far as employees, as size, as facility. So I think that might be part of the planning process, the business planning process. But I really would like to see more goal setting and at least ideas, and maybe even on an annual basis, it would be a good time to touch base with a CPA on.
I agree. I think that I'm not just saying talk to your CPA about it. If you've got banking relationships, I think you should bring those things up to your bankers, to your attorneys. Talk to the team that you've built in order to help your business succeed, and get opinions on these things. Like you were saying, hey, people are setting their goals and saying, hey, we want to grow. We want to get from 12 employees to 30 employees in 2 years. That's all well and good. But if we just focus on employee growth, we can do that just by hiring extra people right now. Really, we have to focus on the growth of top line revenue and ensuring that we still meet our margins. Because if you go from 12 employees to 30 employees, your headaches are going to increase tenfold. And so there has to be a revenue growth to make that worthwhile, most likely.
Agreed. Hey, succession planning was another great topic you brought up that I'd like to spend a little more time on. There's so many different components of succession planning. I'm sure you see a number of clients that have either larger estates and are looking to maybe move on. We see a lot of the businesses, and we see a lot of right now, we see a lot of graying of business owners in their 50s and 60s that are looking to leave the business. And so they're looking to sell. And, you know, one thing at the SBDC, we like to see that done in an orderly fashion. And oftentimes it's difficult because of the years that they might have had during the pandemic, the results that are going to affect the sales price of that particular business. So is there any strategies, any conversations that you have with clients when it comes to actually making that determination, first of all, on the succession side of things to sell, and things that they should be aware of?
Yeah, so when you're making a decision to sell, obviously that's a highly personal decision, and everybody's reasons for selling are going to be slightly different. Generally, when we see people sell, as people are getting a little older, they're getting tired. They don't necessarily want to be involved day to day. So when that happens, the first question we always ask is, if you don't want to be involved day to day, but you still enjoy the business, is there anybody else there that can run the business effectively, or may be able to run the business effectively? Mm-hmm. And so maybe that sale discussion ends up being a discussion on how do we retain ownership while empowering somebody else to run the day-to-day aspects of it. If that doesn't work for somebody and they say, no, I want to sell it, I want to be done, the conversation should turn to, okay, how do we position this business for sale? How you do your financial statements for a business that's going to be for sale versus how most small business owners report things on a, let's call it a tax adverse basis, are going to be incredibly different. If you're going to sell a business, you want to show as much revenue as you can. And you want to show assets on the balance sheet. So something that you may have otherwise expensed, you may want to revisit your accounting policies and maybe capitalize some more assets. If we're leasing vehicles in the business that the owners are using, getting rid of some of those leases, going through and trying to mine the expenses to make the business as profitable as we can in the few years leading up to the sale become incredibly important. Most businesses, as I'm sure you know in most of your most of your participants here know, are sold on a multiple. So they're sold on 2, 3, 4 times earnings. So the higher we make that earnings number, the better price we'll get for the business. So once again, I think if you're going to go through and you're going to do a sale transaction, you need to start having those conversations 2 to 3 years in advance of getting there, rather than just saying, hey, I'm going to sell the business tomorrow. How do I do it? The longer lead time, the easier it is to plan.
Yeah, great advice. It's such an interesting dynamic because you go through trying to cut your taxes all the way since you've operated the business. And sometimes you do things that, you apply more personal expenditures into it than really maybe reflects. And then you try to get back to more of a picture of what a different owner would look like. Yeah. And oftentimes that does result in paying more tax. So it's kind of an interesting dynamic.
And you can try to get to the same point via add backs, going through with the buyer and saying, hey, we want to add this back, we want to add this back, we want to add this back, because you won't have those expenditures. But there's usually a limit as far as what the buyers are willing to add back. And at some point, they're really not going to view these add backs as add backs to the business, because, hey, you know what, if you're taking advantage of these and you're doing all these things in the business, effectively from their standpoint, that's what the business takes to run. They're not going to want to give you add backs for 800 different things.
Right. Hey, well, let's jump into, one last note to you sellers. Your business isn't worth as much as you think it is.
Well, that's probably true.
It's only true 90% of the time.
Yes, unless you have a company that is looking to be acquired by a larger business and they're trying to get into the area, or it's a private equity group that's trying to build an asset base in order to take the company public or to sell to a larger buyer. Yeah, if you have a business and you do, say you're a pest control business, and you're not going to get 7 times earnings on that pest control business. You're going to be lucky to get 2 to 3 times earnings. And most likely it's going to want to be paid out over 5 or 6 years.
Yeah. And a perfect example of that, and I won't even mention the name, that went to private equity was a local car wash that's now here in Bakersfield that is pretty much everywhere, but it's in other regions as well. And it was a concerted effort. And oftentimes when you grow like that, you pay more than the asset is worth. That's a great point. And I do need my car wash, so I probably will go there today.
But as you said, that's not going to be the case for the vast majority of business owners in Kern County.
Okay, let's jump to ERC, the Employee Retention Credit. We've talked about this so much over the last year and a half. And it has changed much since you were here 16 months ago. So give us your update and your highlights and your points on what you see going on with ERC, the Employee Retention Credit.
Yeah, so obviously the credit's still out there. It's still a very, very lucrative credit. There are still a lot of taxpayers out there that do qualify for it, that have not taken advantage of it yet. Probably the biggest development in the last year we've seen is there's a lot of companies out there right now that are sending postcards, emails, phone calls to business owners saying, hey, you qualify for X amount of credit. Let us do it for you and we'll only charge you 20% of what we get back. I'm not a big fan of those groups. I think a lot of those groups are pushing the envelope a lot farther than probably should be pushed, knowing full well that some of it's probably going to get overturned upon audit. Some of these groups are even going as far as making the blanket statement that if you do business in California, you qualify for an ERC, period. No ifs, ands, or buts. And while it is true that a lot of taxpayers inside the state of California do meet the qualifications for the ERC, they don't, it's not a guarantee. It's all going to be facts and circumstances based on everybody's individual business. And I think there's a lot of people that are taking it a lot farther than they should, and probably putting business owners at risk should they get audited 3 or 4 years down the road. I think one important thing to note is that the ERCs, the statute of limitations was increased in the funding bills for them. So when they went through Congress, the statute of limitations was increased from 3 years to 5 years. So the IRS will actually have the ability to audit these things from 5 years after the date you filed it.
Wow. Yeah, we were sharing for a number of weeks an email that I was getting. I think I was being targeted. I think they thought I was California State University, Bakersfield. And I think what they did was they targeted the highest employees in certain regions, because I was getting daily emails. Now, so I was kind of, you know, it'd be nice, but I don't think a government entity can qualify for an ERC. So what do you see as far as from ERC, what are a couple of things, or what do you potentially see as a problem as far as having to go back and redo tax returns?
So one of the things that you got to be aware of when you go through and you claim the credit is that the IRS has resisted calls to allow businesses to report the ERC revenue in the year in which it's received, rather than the year in which the credit was officially earned, or with the credit year in which you're claiming it on the amended payroll tax return. So if you file for an ERC right now, you might not see the money for 8 months. But 8 months, when you get the money, you've effectively got to go back and you've got to amend your 2020 and 2021 tax returns. So for businesses, that can be somewhat problematic in that if you haven't or weren't able to elect out of the new partnership audit regime, you have to file for a administrative adjustment request and flow all the information through and provide the IRS with how much you actually owe. It can be kind of a pain in the ass. Even if you didn't do that, you've got to amend those partnership returns or corporation returns, and then flow amended K-1s out to each individual, who then has to file their own amended tax returns. Each of those will likely affect carryovers into 21. So you've also got to amend 21 for the 21 ERC plus any changes to carryovers. One nice thing about what the IRS has done is they've put out a rev proc dealing with these amended returns, and has basically said, look, we understand that this is kind of a pain in the butt for people, and if you didn't amend your return because you were waiting to get the refunds from the ERCs before paying your tax, we will waive all penalties associated with late payment of tax. Normally, you would amend a 20 return, you would have penalties going from the original due date of the tax, so 4/15 of 2020, you would have penalties up through the date which you pay it. If you request abatement under this rev proc, they will waive those penalties so long as the amendment is related to an ERC credit received at the time of filing of the amended return.
And with those amended returns, wouldn't about every single taxpayer have an amount due? Because part of the amended return is part of the catch of the ERC, the tax credit, is you have to reduce your wages. So if you reduce your wages, then you show more earnings and pay more. So you have tax to pay also.
Yeah, I wouldn't go as far as saying every single one, but you're right. 99.9% of returns that are amended due to the ERC will show additional tax liability. It is possible that they wouldn't if it was a really low income taxpayer and they had earned income credits, and just how those numbers worked with the amount of the ERCs. You could actually have a refund, but it's highly unlikely. Yeah, I mean, most people are going to have a tax liability associated with it. You know, figure whatever your federal tax rate is for 2020, bump yourself up to at least the next bracket, and multiply that times the number that you're going to receive of ERC credits. And that's effectively going to be your tax, or at least a close approximation of it. But yeah, one other thing to note on that is the state of California, based on their law, the view was state of California, these are non-taxable. That was state of California's position as well. In the last 30 days, they've kind of been wishy-washy on that position. And the latest we got about 2 weeks ago was the California views that ERC credits may be taxable in California. So I think what's happening is California's seeing a big pot of money there that they aren't getting a piece of. And so they're trying to wiggle out of the way their tax law actually reads and try to attach these in some manner. So we may see that come down the pipe as well.
So the IRS last week made an announcement also that the rebates that were sent out in California are going to be non-taxable.
Yep.
Are there any other things, or maybe you could even mention that a bit and talk a little to that? And are there any other things out there like that are still kind of hanging and need further IRS or state definition before you know what to do?
Yeah, so when you get into the details of it, there's quite a few things out there in which California and the feds really aren't 100% clear on how they should treat each other's programs. The IRS, like you said, the IRS took this position recently that California rebates, or rebates from any other state that were due to COVID relief, are not going to be taxable for IRS purposes. But that's in direct contradiction to their position a year ago, in which California grants and things like that were issued to businesses during COVID were taxable for federal purposes. So I think what you're going to see is you're going to continue to have several years of back and forth between California and the feds on what they're viewing as taxable. When they don't tax something, it's not so much of an issue because nobody's going to file a claim against the IRS because they didn't tax them on this income. The issue is going to come down things like California, where they try to go back and claw back some of this money. California does that. I think you'll see a lot of lawsuits about it, and it'll be 8 or 10 years before we really see what the courts rule California law is. There's not as much changing as there was a few years back, but there's still constant changes in this stuff.
Okay, well, let's jump in and see what we have as far as questions. It's not too late to get a question in the Q&A box, and let's see what's hanging out in there. Okay, let's start with question number 1. If you receive the EIDL, and I imagine that's the COVID EIDL for the pandemic, yes, you can still apply for this EIDL, being the economic disaster. That is correct. You can have multiple disaster loans, and if you're in the Midwest or maybe some hurricane regions, you could have more than 2 or 3. So yes, if you received an EIDL for the pandemic, for the COVID EIDL, you can still apply for the weather-related disaster program that is going to be open until November. Okay, question number 2. About the employee-sponsored retirement plans. As an employer, I'm required to contribute to an employee's single IRA if they elect to not contribute. Or do I only need to contribute to their simple IRA account if they also elect to contribute?
So,
pretty specific question on retirement for you there, Michael.
Yeah, this is ultimately going to depend on their plan documents. If they have a safe harbor profit sharing type plan in which they basically do guarantee a contribution to all employees if they qualify, you would need to contribute to it. If you were simply, if you have a tested 401k or something in which it's not a safe harbor, in this case, we're talking about simple IRAs. So if you have just a simple IRA that doesn't have a safe harbor component, you would probably only need to contribute if the employees contributed and you had to match. But that's really going to depend on your plan document. What I'd encourage you to do as far as that question is, you should have a plan administrator, somebody that wrote the plan, that administers the plan. That's exactly what they're there for. Reach out to that person. They'll have a copy of your plan document and they'll be able to get you an answer on that right away.
Fantastic. Let's jump in the chat. Sometimes we find questions in there. If not, we'll just kind of review what's been going on. Have information on the marketing program with students. There's information on the FEMA that Maureen has put in, our producer Maureen Busher-Dang. Thank you, Maureen. Also on the employee retention tax credit that links to IRS information. Oh, here's a question. Hi, Michael. Are you seeing your clients' ERC refund checks slow down as tax season kicks in?
Actually, we've seen them kind of speed up a little bit. Throughout last year, they were pretty sporadic. Smaller taxpayers, meaning ones that were getting less than, say, $200,000 per claim, were getting them back in 4 to 5 months. So since January, we've seen a significant number of clients that had big ERCs. We're talking 300,000 to 4 million. Get refund checks in the last 60 days. So it's actually sped up in that regard. IRS, once they process a return, can take 6 months to issue a check. So that really, I don't think tax season itself is going to affect that. It's different groups than the ones that are dealing with the processing of the current year 1040 returns. So I don't expect that to be a holdup. If we do see a significant number of ERCs filed on amended payroll tax returns, that could significantly slow down the IRS's ability to keep up with those claims.
Okay, before I get to your final comments, Michael, just want to know people can contact you. You're with the Accounting Corporation of Barbich, King, Hooper, Dill, and Hoffman. And you know, my bad, I don't have a slide of your contact information. Maybe Maureen can get one in there before we end our final comments here, or get at least your phone number. What's your phone number, Michael, or email?
So phone number is going to be 661-631-1171. And the email address is going to be michaels@bhkcpas.com. And I'll put it in the chat here as well for people.
Fantastic. So many tax questions and so little time.
You know, one thing I do want to mention is we talked a little bit, we got a couple minutes, we talked about the SBA loans. If you had an SBA loan that the SBA was making your payments on that loan during COVID and into 21, the payments that the SBA was making on your behalf are non-taxable payments to you, but the interest and fees associated with those, you still do get benefit of the deductions. So if you had an SBA loan that somebody's making the payments on your behalf, make sure you give that information to your CPA, because you will actually realize a tax benefit for having that done.
Fascinating. And that was for 6 months, the SBA made your payments if you had an SBA 7A loan or an SBA 504 loan, which is their guaranteed program, or their real estate and fixed asset program through Mid-State Development. Those would be the two programs. They might have done something with some of their smaller micro programs too, but I don't recall hearing that. So good to know.
Yeah, and just in closing, you know, look, based on what we talked about today, is if you've got concerns about your business or understand your financials, things like that, talk to the team you've built around the business, get a handle on that, you know, leverage your contacts in order to make your life easier. You guys are best at running your business. So leave the other stuff that you don't enjoy doing to somebody else.
Great advice. Michael, you're a warrior. Thank you for coming on. Short notice and all.
Hey, my pleasure.
Short notice and all. Great topic. Something we could probably talk about for much, much, much longer. A lot of different topics and things. I know you're starting tax season. You're going to be a little busy the next couple months. I won't actually be out working on my tan during the next couple months, if that makes you feel any better. But good luck during tax season.
Hey, thank you very much. And I hope everybody got something out today, and we'll see you guys later.
And we're out of time. So we will be back next week for webinar number 264. We'll be talking about the USDA grant for value-added producers, taking that commodity and adding value to it. USDA's got money for you. Competitive process, we'll find out all about it. The application's due in a couple months. So for Michael Stevenson, Kelly Bearden here, and Maureen Busher-Dang, we'll see you next week. Goodbye, everybody.